Good afternoon, and welcome back to another episode of the Grimaldo Group, where we love helping families create wealth through home ownership. And my name's Angel Ramos, a realtor here with the Grimaldo Group. But I have with me as a special guest, Phil Arnieri. Phil, how are you?
I'm good. Thanks for the pronunciation.
I always try my very best. Phil is originally from the Chicago area.
Yep.
But decided to move to Paradise, to the oasis in the desert. How long have you been in Phoenix for?
I've been here for over 20 years now, since 2001.
Wow. So you loving it here?
I'm loving it. Yep, I am.
So, and Phil is here because he has some programs something that you have in the oven, so to speak.
Yeah.
That can help clients.
Yeah.
It's with assistance with down payment assistance.
Yep, it is. It's down payment assistance through the SPCP program through one of the outlets that we work with, UWM Mortgage.
Okay.
So what I really like about this program is they're reducing the interest rate. One of the things about a lot of the assistance that I don't like is the high interest rate.
Okay.
Interest rates are already high enough. We don't need the rates to be higher because it's assistance.
Okay.
So, and they're also going to reduce their mortgage insurance for them as well.
No.
Especially, there's a lot of people that don't have a ton of income that are really credit worthy, that have really good credit scores. So I feel like Fannie Mae's done a really good job of finding this niche of people that could really benefit. And they're in specific areas in Phoenix, Chandler, and Mesa.
Okay. So Phoenix, Chandler, and Mesa. So the house that they are wanting to purchase.
Current residents.
Okay. So their current residents needs to be in those three cities.
Exactly. Yes.
But they can go and purchase elsewhere?
Yes.
Okay.
Yeah. They just have to have their current residents be in this area.
Phoenix, Chandler,
and Mesa.
Or Mesa.
Yep.
And then what is the minimum FICO score? 620?
They're at 620, yep, for the minimum FICO on that one. And there's no actual income limit, which I love as well. A lot of people, they're just barely over the income limit, or that becomes a sticking point for a lot of people. So I feel like they've done a good job of making this available to more people.
And this is Fannie Mae?
Yep.
Okay.
Yeah, it is. They do need to take a home buyer education course, which is another thing that I love. I think everybody should just do that, even if it's not mandated. Because as the loan officer, my main job is to educate.
Yeah.
But I can only educate them so much. I feel like a good, formal, quick education wouldn't hurt any buyers.
So is it just a one-day course, or is it online?
Yeah, it's online. It's a self-paced course, but it's going to be nothing but help people.
Correct. So sometimes people get scared about, hey, I got to take a course. It's not that tedious, and if it's going to allow you to purchase a home, isn't that beneficial?
100%. Yep.
And so in addition to, so it's $5,000 of assistance.
$5,000 assistance. They get $500 credit for the appraisal, and they can get a $500 a 1-year home warranty. So I love everything about that. You don't have that air conditioner going out.
Yeah, that always comes in handy. Is there anything else other than this particular program that regarding interest rates? Where are they hovering right now, the interest rates?
Interest rates, thankfully, are starting to head down. I was pricing out some loans yesterday. FHA and VA were in the middle 6% range.
Yeah.
With really good credit, they're even a little bit lower. Conventionals getting closer to 6. They were a little bit above 7, but really good indicators that in 2024 we're going to see those rates go down again for us a little bit.
Well, I mean, I remember when I had a 7.5 interest rate back in 1998, which was actually pretty good. And now you're talking about, it's all about perspective, because when the gas prices were at $2 or so dollar, right, a gallon, and then they went up to $6 and then go back to $4 or $3.90, you start saying, hey, gas prices went down, right? And the same thing goes with the interest rates. Now, let's talk about concessions, because sometimes people only see the price of a home as they're going through Zillow, Redfin, and whatever other site is out there. And they see a price for a home, and then they say, I'm not even going to qualify for that. Concessions are provided at the negotiation table when you place an offer on a house that you are interested in. And to place an offer, you have to have a pre-qualification.
Correct.
And that's where it's very important to be talking to a lender and be pre-qualified. Yeah. With the pre-qualification letter and the offer is submitted, we can request, seller, please know that we are placing this offer, but we're requesting, for example, maybe a 3% concession of the purchase price to go to a rate buy down, okay? And it goes to the lender, correct?
Correct.
What can you elaborate more regarding concessions? Because some folks that I've been working with, they thought that the concession would be going straight to them.
Yeah.
And that's not the case.
Concessions, a lot of the concessions is one of the most misunderstood things by new home buyers. They have no idea what concessions are. They think it's a concession stand. You know, we could go and buy a hot dog. It's, you know, concessions are going to be capped on an FHA loan at 6% concessions. When you really think about it, if the seller is really motivated, you can pretty much pay for all of their closing costs. And if you were able to get maximum seller concessions, which on a lot of things that buyers don't, or a lot of times buyers don't realize, is when rates do really go down significantly, those concessions, and you can chime in this, they go away. So the sellers have people knocking down their doors. They're not going to give anybody concessions.
So that's why it's important. For example, when the rates were in the low threes or even in the twos, there were no concessions. The sellers had the upper hand. If you want to buy my house, you're going to have to pay me more than what the purchase price is, what I'm selling it for. And because they had multiple offers.
It was crazy.
Whereas now, the seller, having X amount of equity into the house, they want to sell. If they're motivated to sell, they're going to be more willing to provide a concession. A concession is a form of a gift, all right, towards helping you have more buying power. Because if we reduce the interest rate, it allows the buyer a higher probability of being able to purchase the house.
And not just a temporary buy down. Temporary buy down is cool, but I'm not a big fan of temporary anything. I want a permanent buy down. I want to know that my rate is not going to adjust anytime soon, you know?
So say, for example, if a house, the going rate more or less is $400,000 and the seller agrees to a 3% concession, just can you throw some numbers out there or a scenario that can more or less?
Yeah, if the seller were to agree to pay for 3%, that's a significant amount of concessions to be paid for on that. You could definitely get all of your closing costs covered, and depending on the buyer's profile, depending on how much they're putting down, depending on how their credit score is, you could even help them chip away at that interest rate a little bit.
Okay. So that's not a bad deal. It certainly helps getting more buying power to get
it's the name of the game, and affordability. You know, first question out of people's mouths is, what's my monthly payment going to be? Second one is, how much is this going to cost me in total?
Now, I don't have a crystal ball, but, you know, even when the rates were at 7.5 or even 8%, I would encourage clients, buyers, hey, if you really want to purchase a house, this is not a bad time to buy it. I mean, every time is a good time to buy. Anytime you get out of renting is always a good time. But I would tell them, because the interest rates had increased, you can potentially get a concession, 3-4% concession, maybe reduce your interest rate or get your closing costs covered completely. That's a lot of savings. And then down the road, if interest rates, if and when they start coming down, then you can refi.
Yeah, take advantage of that.
Instead of paying rent, and waiting for the interest rates to try to go as far as I don't know what, you know, we're probably never going to see 3% again or 2.5, and maybe sometime in the future 4.5, right? But I always encourage them to just look at the possibilities you have now, where you could refi later if the interest rates drop, but you're already paying a mortgage that works towards buying or reducing the note. Instead of paying rent, and then the moment that the interest rates do fall, now you're behind the curve. And then the concessions are probably going to go away.
Yep.
And now you're having to put money towards the house above what the stipulated price is.
Yep, they're going to have to come above and beyond that purchase price, and a lot of people aren't in a spot to even do that. The people who say they're waiting. If you ask, the next question you ask them is, are you prepared to pay over asking price?
Correct.
That should be the next question of those.
And not only that, do you have the closing costs?
Yep.
Because what's the average closing cost hovering at?
Typical closing costs are about 6 to 7 grand, depending how expensive the taxes and insurance are.
Yeah. And at times I've seen them even a little bit higher than
Oh, yeah.
that, 8,000. So in today's market, you can potentially get that taken care of by the seller.
Heck yeah.
But once that starts going away, not only do you have to bring more money to the table to buy the house, because if it's being offered at 400, you may have to offer 410 and still come in with your closing costs.
Just to even have a chance.
Correct.
Just to even be in the game.
So now, can you, with regard to concessions and the rate buy downs, sometimes you hear the rate buy downs not only for 30 years, but there are rate buy downs that is 2 and 1. Can you elaborate on that?
Yeah, like a 2-1 buy down?
Correct.
Yeah. So a 2-1 buy down would be the person's interest rate is locked, for the first 2 years, and then it's going to go down to adjust. Those are decent, but again, I don't like that because nobody wants next year to worry about, my rate is a full percentage point higher.
Yeah.
That's a significant adjustment, a whole full percentage point. For most people, average loan, that's going to be a couple $100 jump.
Yeah. No, I mean, everyone has their needs, and in the case that someone needs to get into the house, and I think there's always pros and cons.
Yeah.
For example, I had one client, he got a concession and rate buy down. The first year it was going to be 3.5, and then the following year 4.5, and then the third year through year 30, 5.5. And if the rates were to drop down the road, he could always refi.
Yeah.
But that helped them because moving into the house, you may have additional expenses.
Oh,
and
for
it's
sure.
always nice to have the mortgage payment as low as possible. And so that worked for him. Others, as you indicated, would rather, no, I want to start from the get-go, do the 30 years. How low can I go with the concession to buy down my rate?
Yep.
And so 30 years, and what is the going rate right now with a concession that someone can potentially get a rate buy down for 30 years?
If you got a really healthy amount of concessions, you could touch something in the really low 6s, maybe even upper 5s,
Nice.
if you really got them nice concessions. So, I mean, now at that point, you're back to rates. When the rates were fairly reasonable.
Yeah.
So, and still, they could always still refinance if the rates go really crazy.
Well, now because the interest rates are slowly dropping.
Slowly.
Because we're hovering at, 6.5?
Yep.
From not too long ago, we were 8%.
It moved very quickly.
So it's election year coming up, and all indications are, and again, I don't have a crystal ball, but the indicators are showing how it's slowly going down.
Yeah.
And then the first quarter of the year, the real estate market, you start seeing the engines, so to speak, they start turning on.
Yeah.
Second and third quarter is just fire. Every year I see this. And then the fourth quarter, that we're still in the fourth quarter, it's kind of slow, but those that are buyers out there have the ability to go shopping and can be a little bit more picky, so to speak.
Oh, yeah, they're in control.
They're in control. Rather than waiting for the second and third quarter, that you do have a lot more activity, therefore you have a lot more competition.
Just like anything in life, more you wait, the less in control you are.
Yep.
Something.
So the demand is there. Now, is there any other product or anything else that you'd like to mention regarding loans?
So as a broker now, we've got about 15 different underwriting outlets to choose from. So if somebody does have a unique scenario, there's all sorts of things, that can happen in home loans where sometimes an underwriter just doesn't want to sign off on a scenario. And when you work with like a retail lender, for the most part, you're just stuck with that underwriter.
Yeah.
If that underwriter doesn't like the loan and wants to decline the loan, you don't have any real other options to turn to. But with my guys, I've got so many different options. It took me a minute to get used to wow, I can really shop this thing around.
Yeah.
And it's going to be nothing but beneficial to our clients.
Well, that's always good to know because I always encourage my clients, you have to have a proactive lender.
Yeah.
Not only a proactive realtor. And if you have a lender and your realtor working together in unison, it becomes like the power team. And it just makes things a lot more effective for the client.
And I find the process of being a broker, I work with Carly Nelson, who's an amazing kind of a pre-underwriter. So she takes over a lot of the paper pushing, a lot of the disclosure, the loan disclosures that go out. She takes care of all of that so I can focus on the client and prospecting for new leads and helping new buyers. It's a really, really good system. The last loan we did, we were clear to close in 7 days. A beautiful
7
house in
days.
Scottsdale for someone.
Well, that's a very important thing that you brought up, because I have also run into situations where a lender is going to provide a pre-qual, and it's just hitting the surface of the person's finances.
Yeah.
And then we go on the contract, and as we get close to closing, that's when the underwriter is very meticulous and going through every little aspect of the person's finances, only to find out they're not going to get the loan.
The layers of the onion start to get peeled back. Like we used to say in our team, the hairy dog gets hairier throughout that transaction.
Very
By the
frustrating.
Oh yeah, that thing is engulfed in hair by the time
Yeah.
you're a day away from your close of escrow.
And so it's heartbreaking for the clients, because
Yeah.
they are so overjoyed with the fact that they're soon going to get the keys to their house, only to find out that they're not. And
That could have been prevented up front
And-
if they would have pushed as hard as they could.
well, and that's why I like working with lenders such as yourself. In advance, you go meticulous. It's better to do it up front, and that way we can address things way in advance. And then instead of going on to contract with a prequal that just hits the surface enough to get a prequal
That doesn't
and
that's not
make the
sufficient.
person feel happy, it's kind of giving false hope. I mean, we've had instances where the client, as we begin the process to get a pre-approval, hey, you need to address these things, and it's going to take you like 3 months or 4 months, and they do what needs to be done, and then they really, truthfully, are pre-approved.
Yeah, that's why each loan scenario is so different.
Yeah.
You know, some of them are super clean. There's maybe one item on their credit. They're a 780 credit score. They've been at the same job for 10 years, and it's a W-2. Some people, it's a much different scenario. They've got disputed items on there. They've got collections.
Yeah.
They've got all sorts of stuff.
But it still can be done. It just requires
Yeah.
more. It's a more tedious process, not only for the lender but for the client itself, because you're going to be calling and addressing things and so on. And that's the part that unfortunately sometimes people would rather not deal with. But if it's going to get you from renting to become a homeowner, I think it's really well worth it.
Yeah. For most
So-
people, it's the biggest financial decision that they make in their lives.
Building equity through time. As you continue to pay your mortgage, the mortgage tends to remain the same throughout the years, whereas rent keeps going up,
Yep.
and it just eats up people's pay increase. Your salary increase is just going away, flying away.
The average net worth of a homeowner is 40 times greater than the average net worth of a renter.
Yep.
If anybody, I mean, that's just always, I always go back to that. Like, you can't really argue against that.
Now, regarding 1099s, or folks that are their entrepreneurs, their own small business owners,
Yeah.
what can you provide?
So for those types of individuals, we always recommend that they do have 2 years of their filed tax returns. It's always going to be the easiest way to help them. We do have bank statement loan type options.
Higher interest rate.
Typically, they're going to have a higher interest rate. They're going to require a little bit larger down payment.
But it can be done.
It can be done. You can also take like a 1099 person and add a W-2, maybe a spouse to them, to that loan, to help that too. But yeah, we get some of those sometimes. But yeah, you just really got to watch out for them.
And then for those folks that have never heard about cosigners, you can potentially get approved if for any reason you don't have your finances maybe up to speed, so to speak. But have you ever had situations where a cosigner comes in?
Absolutely. It happens quite a bit. Unless the person is just on their own and they have a significantly high income, let's say their income is 10 grand a month, there's a chance that that person is probably going to qualify on their own. But if you're making 4 grand a month, just a mortgage is going to be probably 2 grand. And if you have a car payment,
Yep.
you're probably going to want to introduce a co-borrower. a lot of the younger buyers, they want to be independent. They want to go in on their own. Yeah. So I have to suggest the co-borrower and then foreshadow and say, like, look, this isn't for life.
Yeah.
We want to get mom or dad off the loan, or your sister or brother. They're not on this. They're not signing their life away to you.
Correct.
This is just to get you in the door.
And then sometime in the future, you can refi and put it under your name.
Absolutely.
And now remove the cosigner from there.
And they can go and get a mortgage, or they can be, free of that debt when the time comes.
Again, where there's a will, there's a way.
Yeah, I think because mortgages are 30 years, the 30-year concept scares people. They think that they're going to be in this thing for 30 years when they're not.
Yeah, it's like marriage, right?
Well,
cut. No. But it's like, I had a young man tell me, Angel, I don't want to buy because what if I get fired? And I says, well, if you get fired right now, what happens? Aren't you paying rent? He says, well, there's a pretty good chance I'll get evicted.
Same thing.
So if you get evicted to go rent again, that's going to be a problem. Whereas being the homeowner, you have more options. You can talk to the bank, or the mortgage company, there's even rent your property, because if you were renting as a renter and you get evicted, you're going to have to go find some place to live.
Gotta go
and
somewhere.
I asked them, where would you go? I don't know, maybe my cousin's house for a while till I get myself back on the feet. Well, the same goes with homeownership. You have more options as a homeowner in that scenario that you presented as an excuse not to purchase.
Totally. Okay? If you have any issues with your job security, like the stability and the financial security of owning a home is always going to be a better bet than just renting. Yeah,
I just felt that he was just, again, concerned about home ownership. That's just such a big commitment. But he forgot renting is a big commitment too, because if you don't pay the rent, you get evicted.
I've heard in some instances where renting, the credit score that's required is sometimes even a higher credit score requirement. I don't know a ton about renting and what they're requiring, but I have heard some of them want like a 680 credit score.
Well, not only that, the moment that the landlord, the owner of the property, wants the property back, you vacate. Now you got to go find some other place, move again, and you're dancing around
And I've heard some of them want income that's 3 times the rent.
Correct.
So that's
just some food for thought. Any last words?
Yeah, check me out. Level Up Mortgage, doing that 1031 exchange class, January 23rd at Harley-Davidson in Scottsdale. It's going to be incredible. Sponsoring it with Vivian from Greystone Title. 1031
exchange, that's a good subject, because there's a lot of folks out there that are not aware of it, and they are investors. Inexperienced investors. They have their primary home, then they have another property that is an investment property where they have tenants in it, right? Mm-hmm. And all of a sudden there's a need to sell for whatever the case may be. If they don't know anything about 1031 exchange, they're going to be paying a good chunk of money to Uncle Sam in taxes.
Yeah, it's going to be a good class, and it gets you your CE credits too. So I'm really proud to be sponsoring it, and it looks like it's going to be a really cool location. Awesome. I don't ride Harleys, but if you want to check out Harleys, that's on you guys.
Just make sure you buy a house first.
Yeah, for sure.
Right?
Yeah, you can't. You got to have a house first.
You go buy the motorcycle first. I knew of someone that got the motorcycle, $1,000 in payment, then couldn't get the house.
Put the bike before the house.
So it's better to put the house before any big ticket items.
House before the Harley.
Affirmative. Yeah. So
there we go.
Again, Phil Arnieri, and what's the company again?
Level Up Mortgage.
Level Up Mortgage. We'll have his information. If you have any questions, concerns, I'm sure he'll address them. And feel free to call us here at the Grimaldo Group. Always happy to help people with creating wealth through home ownership. And we're always here to assist. Thank you very kindly, and God bless.
Happy holidays, everybody.